Hi everyone, today we'll be going over accounts, May June 2018, paper 2 question number 2. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. And since question number 2 is of 15 marks, we will be attempting to solve this question under 15 minutes. Now without any further delay, let's get started. M Limited has provided the following extract from the Statement of Financial Position of 31st August 2016. So for equity, we are given our capital and reserves. There is ordinary shares, share premium, revaluation reserve, as well as retained earnings. And then the following information is available. First of all, let's have a look at the given question. For the first part, we need to prepare the statement of changes in equity for the year ended 31st August 2017. And the total column is not required. So let's first prepare our statement. We are preparing it for M Limited. And this is a statement of changes in equity. And this is for the year ended 31st August 2017. So the headings that we need to include in our statement of changes in equity is just going to be ordinary shares, share premium, revaluation reserve, and retained earnings. So let's write it down. We have our retained earnings. Then we have our revaluation reserve. We have our share premium. And finally, we have our ordinary share capital. Okay, I'm just going to draw lines so that there can be some sort of division. Alright, then we will be starting with our opening balance. And we can see that our closing date is 31st August 2017, which means that our opening balance is going to be 1st September 2016. So that's balance at 1st September 2016. Let's have a look at our given information. The given information is of the date 31st August 2016. Which means that this is the closing date for the year ended 2016, whereas we are trying to figuring out our statement of changes in equity for the year ended 2017, which means that this will now act as our opening balances, right? So the opening balance for ordinary share is 200,000. Let's write it down. That's 200,000. For share premium, we have 80,000. Let's write it down. Then for revaluation reserve, we have 40,000. Let's write it down. And for retained earnings, we have 37,500. Let's write it down as well. Alright, now we can move towards the transactions that took place in this particular year. So the first one is that on 1st January 2017, a rights issue was made on the basis of 2 ordinary shares for every 5 ordinary shares held at a price of 0.40 per share. So we can see that our nominal rate is 0.25, and if we're issuing our rights shares at a higher price, then it means that this also includes a share premium, right? So for ordinary share, the value is going to remain at the nominal rate of 0.25, but if we're talking about the share premium, then the remaining value will be invested in our share premium. So that's just the difference between 0.40 and our nominal rate of 0.25, which gives the value of 0.15. Okay, and we are told that the rights issue was made on the basis of 2 ordinary shares for every 5 ordinary shares held. So we can just write it down as an equation. For every 5 ordinary shares, we gave out 2 rights shares. Then for every 1 ordinary share, this is just the unitary method, we give out 2 by 5 rights shares. So now we need to figure out the total number of ordinary shares. All right, let's do that right here. So number of ordinary shares is just going to be the total value of ordinary shares divided by the nominal rate. And we can see that our total value of ordinary shares is 200,000. Let's divide it with the nominal rate, that's of 0.25. So this gives the total number of ordinary shares to be 800,000. Now for 800,000, we need to figure out how many right shares to issue. Okay, so that's just going to be 800,000 ordinary shares equals to 2 by 5 times 800,000 right shares. So the total number of right shares issued is just going to be 2 by 5 times 800,000, which results in 320,000 right shares. Now we just need to figure out its value to be recorded in our ordinary share and share premium. We can see that the ordinary share rate is 0.25. So for ordinary shares, that's just going to be 320,000 times the nominal rate of 0.25, which gives the total value to be recorded in the ordinary share on the rights issued to be 80,000. Okay, then similarly, we also need to figure out the value for our share premium. And for share premium, we again have the same number of units, which is 320,000. And we need to multiply it with the rate of the share premium, which we figured out here. That's 0.15. Let's multiply it. So this gives the value of the share premium to be recorded under the heading of share issue to be 320,000 times 0.15, which results in 48,000. Okay, so we will be recording this value in our column of the ordinary share capital and this value in the column of our share premium. So we can just term it as rights issue. And for ordinary share, it was 80,000. And for share premium, it was 48,000. And the rights issue does not affect our revaluation reserve and retained earnings. So there's not going to be any value for those columns. Let's have a look at our another transaction. On 30 June 2017, an interim dividend of 0.04 per share was paid on all shares in issue at that date. So all shares in issue at that date is just going to be our balance, opening balance, as well as the rights issue, right? So the total value of our ordinary shares for the interim dividend is just going to be our opening balance of 200,000 plus the rights issue of 80,000. So this gives our total value to be 280,000. Now we need to figure out the number of ordinary shares for this corresponding value. And we know that the number of ordinary shares is just going to be the total value divided by the nominal rate. Total value is 280,000. And we know that our nominal rate was 0.25. So this gives the total number of ordinary shares at issue at the date of interim dividend to be 1,120,000. Okay, and what we know is that the interim dividend paid was 0.04 per share. So the total dividend paid is just going to be the number of ordinary shares times this rate per share, right? And we just figured out our total number of ordinary shares to be 1,120,000. So that's 1,120,000 times the rate of dividend, which is 0.04 per share. So this gives our total dividend paid to be 44,800. And since we know that dividend is a part of the profit distributed to shareholders, we always need to reduce our dividend value from the retained earnings column. Let's do that. So that's interim dividend paid. And dividend paid was of 44,800. This needs to be deducted from the retained earnings. And this does not affect our ordinary share capital, share premium, and revaluation reserve. So there's not going to be any values for those columns. Now we can have a look at the third transaction. So at 31st August 2017, non-current assets were revalued downwards by 48,000. So if it were revalued upwards, we would have added the amount to our revaluation reserve. But since it is being revalued downwards, we actually need to subtract this amount of 48,000 from our revaluation reserve column. So let's do that. we can term it as revaluation. And the amount it is being revalued downwards by is 48,000. But we can see that the revaluation reserve only contains 40,000, which means that the maximum amount revaluation reserve can sustain is 40,000, right? So we can only record 40,000 or only reduce 40,000 from our revaluation reserve. But the total reduction should have been 48,000. Out of 48,000, we already reduced the 40,000, so the remaining amount is of 8,000, right? So we also need to reduce this 8,000, but we will reduce this from our retained earnings column. That's the rule to keep our reserves in the most flexible form. So let's reduce the remaining 8,000 from the retained earnings. Now, the revaluation does not affect ordinary share capital and share premium, so there's not going to be any values for those columns. Okay, now we have our final transaction. So that's profit for the year ended 31st August 2017 was 22,500. And we know that profit for the year is always added towards our retained earnings. So let's do that. Profit for the year. And it was 22,500. We just need to add it to our retained earnings column. And we know that profit for the year does not affect ordinary share capital, share premium, and revaluation reserve in any way. So there's not going to be any amounts. And this concludes all of our transactions. So now we can move towards figuring out our closing balance or balance at 31st August 2017. Okay, so for ordinary share capital, that's just going to be the sum of these two amounts. That's 200,000 plus 80,000, which results in 280,000. For share premium, that's going to be the sum of these two amounts. That's 80,000 plus 48,000, which results in 128,000. For revaluation reserve, that's going to be the sum of these two amounts. So that's 40,000 minus 40,000, which results in 0. And for retained earnings, that's going to be the sum of these four amounts. So that's going to be 37,500 minus 44,800 minus 8,000 plus 22,500, which results in the value of 7,200. Alright, this concludes the first part of this question. Now we can move towards the second one. We need to state two reasons why capital reserves may be used before revenue reserves to finance the bonus issue of shares for a limited company. So the very first reason is to retain reserves in the most distributable or flexible form. Let's write it down. To retain reserves in the most distributable or flexible form. And secondly, because we know that revenue reserves are used for distribution of dividends towards the shareholders, but capital reserve cannot be used for that particular use, right? So this is the reason why we use capital reserves for the bonus issue of shares and revenue reserves for the dividends paid. Let's write it down. Revenue reserves are needed to fund the payment of dividends to the shareholders. Alright, this concludes the second part of this question. Now we can move towards the third one. For the third part, we need to state two benefits to a limited company of making a rights issue. So whenever we issue rights shares, it avoids any dilution of ownership because rights issue are issued to the already existing shareholders, meaning that no new shareholders can enter, which means that the ownership will remain the same and not be diluted. Let's write it down. Would avoid any dilution of ownership. And the next one is that the rights issue is a permanent source of capital which does not have to be repaid, right? So rights issue is a permanent source of capital which does not have to be repaid. Now for the second part, we need to state one limitation to a limited company of making a rights issue. So the limitation is that after issuing a rights share, the market price of the share will fall down. So let's write it down. Can lead to a fall in the share price. Okay, so this concludes the third part of this question. Now we can move towards the fourth one. We are given additional information. The directors of M Limited are considering obtaining a long-term bank loan to raise additional capital. Now we need to explain two advantages to a company of this course of action. So we just need to write down the advantages to a company of taking a long-term bank loan. So let's compare it with share issue. So if you issue shares, then the time taken for the funds to be received is very long as compared to the time taken to receive a long-term bank loan. So let's write it down. Funds are received quicker than a share issue. Secondly, a long-term bank loan does not dilute the ownership, meaning that the ownership will remain the same and therefore there will be no loss of control to existing shareholders. Let's write it down. Ownership remains the same and therefore no loss of control to existing shareholders. Alright, this concludes the fourth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.